You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
You wanted it, you got it. A radio program that helps teach you options trading inside and out. Basic to complex. This is Options Bootcamp. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo and Dan Passarelli.
All right, everybody. That rockin' tune means it's time once again for Options Bootcamp, the program here on the old Options Insider Radio Network, where we break down this crazy world of options into nice, easily digestible chunks for you. Maybe you're the basic retail stock guy. You're thinking about dipping your toes into these options waters. You're saying, are they too frothy? Are they too turbulent for me? Don't worry. We got a life jacket for you. Or perhaps you're a more experienced stock guy. You've done a little bit of options trading. You want to learn a little bit more. Maybe you want to go into the deep end. We got you guys covered too. And of course, if you're just joining us for the first time, welcome. And then, of course, you got a lot of great archives to sink your teeth into and learn a lot. And the great thing about this show is it's pretty much evergreens. You can tune into it anytime, anywhere, any place. And an iron condor is still an iron condor, a call is still a call, a put still a put. So you can go check it out. Easiest place to find all the archives, of course, the mothership, theoptionsinsider.com, as well as, of course, iTunes and iOS and Stitcher, as well as, of course, via our mobile app, available for iOS and Android, and the ever-popular Fire OS. Got a little treat for you guys, too, doing a little surprise live stream of this one as well. So for those of you who are uber hardcore and available, can take a break from work for a little bit. Maybe you want to stream while you're listening to work. You want to learn a little bit about what we're talking about today. Well, we got you covered there. The easiest place to do all that, of course, is our Mixlr live page. Just grab that live link. It's the same all the time. And then you can follow us on Options on Twitter or on StockTwits. We tweet out the link there all the time. Once you grab it once, you're good to go. All of our live shows go out through that same link. Or you can even make your life easier, follow us on Mixlr, and then you get notified whenever we go live, and you too can tune in and have all the fun. Speaking of all the fun, I'm not having it all by myself on the show today. No, I am joined for the fun by my Options Bootcamp fellow drill instructor, he of the dark hat to my light hat, Mr. Dan Passarelli, the founder and CEO of Market Taker Mentoring, as well as the author of many seminal options education tomes. Mr. Passarelli, welcome back to the Bootcamp Drill Instructor Squad Zone, sir.
Well, Mark, I am very happy to be here. Yep, nice, beautiful, sunny day here in Chicago. Great day for a podcast.
Yep, good day to be inside doing some radio, don't you think?
Definitely.
We're going to break it down, actually, with a little. Let's get started here with a little bit of what we like to do on the show. Sometimes we'll do some Options 101, which are some basic concepts. Sometimes we'll dial it up a notch and do a little bit of a segment we call Options Drills, where we tell you how to take some of those concepts and apply them in maybe an interesting and fun new way. And we're going to do just that right now, I should say, with a little bit of some options drills and some calendars over earnings.
Calling boots. Time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, everybody, welcome to the old options drills, the portion of the program where we take those specific option strategies and tell you how to accomplish a specific objective, like the man said. And today we're doing something a little bit different. We're going to talk about some fun ways to trade earnings, including our old favorite, the calendar spread. If you're wondering what inspired this, well, it's our good buddy Dan and his ever-popular newsletter. It comes out from Market Taker Mentoring. They talk about a lot of interesting concepts, and they also hit on some nuggets. And one of the ones they talked about recently, which I thought would be a good topic for this program, is calendars during earnings. Before we even get to that, Dan, if our listeners are intrigued, they want to go sign up for said newsletter, how do they do that? Where do they go? What should they do?
Oh, just surf on over to markettaker.com. That's market like stock market, taker like take something. So 2 T's in a row. Markettaker.com. And it's right there smack dab on my homepage. Just click on free newsletter sign up.
It's pretty straightforward. I got to admit, the 2 T's always throws me too. I always put 1 T in for some reason. Remember the 2 T's, listeners. So you don't want to go whatever that one with 1 T is. You don't want to go there. It's probably some dark and disturbing place. Go to the 2 T's, markettaker.com. Sign up for the newsletter. You can get nuggets like this. But, it's an interesting conversation, Dan. I thought it was worthy extrapolating a little bit here on the old program today. Again, if you want to deep dive into calendar spreads, check out our archives. We have episodes devoted to just that, a full, most of an hour, breaking them down. We'll do a quick rundown now for you if you're not familiar with calendars. Calendars are, like the name implies, a trade where you're actually doing time in the spread. Usually when you're doing a typical spread, it's usually what we consider to be a vertical. Usually it's in the same expiration month. So maybe you'll buy an at-the-money call in XYZ stock, which let's say XYZ is trading 100. You want to buy a vertical call spread. So let's say you buy the at-the-money 100 call, and then you sell the 105 call. You bought a $5 call spread. It's all in the same month. So it's considered to be a vertical. And that's where most people tend to play. I'd say, I don't know, of the spreads we see, somewhere around 70% are probably in that vertical range. But calendars go beyond the single month of trading. They add multiple months into the mix. And I often consider, maybe Dan, you agree or disagree, I'd be curious to get your thoughts on this as well. I kind of consider calendars to be one of the points where the rubber really meets the road for a lot of options traders. It's kind of where the more sophisticated guys tend to play, because there are a lot of different things at work. You have time, you have gamma, you have theta, you have vega, you have all these differing factors kind of coming into play, and they're at different levels because you have 2 different months, not all in the same month. So I find calendars to be on, shall we say, the more sophisticated end of the spectrum. Do you agree with that? And is that how you guys teach them over there at MTM?
Yeah, calendars are definitely on the more sophisticated side of the spectrum. And that's, I think a lot of people don't appreciate that until they get the, what the WTF just happened to my trade, experience a few times. I think a lot of people look at calendars and they're like, buy this one, sell that one. Yeah, it's easy. Here's what the P&L diagram looks like. It should stay between there and there. And okay, got it mastered. But you don't, because volatility, calendars are very, very rooted in volatility skew. And without a real pretty solid understanding of that, they can be pretty tricky to trade. At least pretty tricky to be successful with them in the long run. But I'll tell you what, once you do have the volatility component of time spreads down, I think they're probably your most powerful strategy.
Interesting. We'll extrapolate on that in a little bit, I think. Let's break it down a little bit further first before we do just that. There's a couple of different flavors. You can obviously play calendars. You can go from the dark side, the short. It seems like most people, particularly to start, tend to go long because that's, I think, a little bit easier for people to wrap their heads around than going short. That's also the style of trade you guys broke down in your newsletter. So why don't you walk us through, Dan, maybe a basic example of what a long calendar is versus a short, and then also why you guys chose to go that route for discussing the trades during earnings in your newsletter.
Sure. A long calendar is when you buy the longer term option and sell the shorter term option with the same strike. So, I might buy, for example, a 3-week 50 strike call and sell a 1-week 50 strike call. So that's, in a nutshell, like in a very overly simplistic way, that's what a calendar is. That's how you construct them. So that's a long calendar. If I were to trade a short calendar, it'd be just the opposite. I would sell the longer term option and buy the shorter term option. Now, first of all, the reason why most people trade long calendars is there's a couple reasons. One is I think they're kind of easier to understand and easier to manage. You have time on your side because shorter term options tend to have higher theta than longer term options. So even though I have a completely hedged position, limiting my loss, I have time decay working on my side. So, a lot of people like that. Now, with short calendars, there's a couple problems. One is, you have time decay working against you, but you have gamma on your side, like movement is good, but it's only good to a point, like if I'm looking for a volatility play, well, if it's a little bit of volatility, the calendar can work pretty good. But if it's a lot of volatility, you're tying up a lot of capital, you're taking a lot of risk, and if there's a big move, you only make a little bit. So they're not really good for retail traders. They're okay for professional traders who are really just trading the term structure volatility, but not so much for retail traders. And then one more thing is that margin. To trade a short calendar, you get margin pretty oppressively because since you would be selling the longer term option, the brokerage firm says, well, after the short term long option expires, then you're left with a naked call or naked put or whatever. So we're going to margin you accordingly. So you tie up a whole bunch of capital for not really a good risk reward.
Yeah, tying up capital is another part of the equation. It's not the sexiest part of options education, the efficient use of capital, but as people start to get a little bit more experienced with options, it tends to be one of the more frequent questions we get. How is this buying power calculated by my broker? What can I do to maximize that? And so efficiency of capital becomes very clearly and very quickly a very important thing. Let's dig into some of these examples you guys are talking about over there in the MTM newsletter. Again, you were talking about in your newsletter, and I think the topic we want to dig into today, of course, is typically long calendars, like you mentioned. That's the more retail-friendly type strategy, and doing it during earnings. And there's a couple of reasons why. You mentioned volatility skew. People usually think of volatility skew as, being that, the skew of the single month and how it compares the puts to the calls. People also apply that term to the kind of the volatility term structure overall as well, sometimes of, the months themselves. And that's kind of what you're referring to a little bit here when you're saying that effectively you want to take advantage of months that are high versus months that are low. And in earnings, as we all know, earnings is a great time for a little bit of juice, a little bit of volatility in there. We tend to typically see during the month, or the option really could be a weekly or could be a monthly, that where the earnings is actually taking place, the earnings announcement, you're usually going to see a nice little pump, a nice little pop there from an earnings volatility perspective, an earnings volatility standpoint. That's something you can take advantage of as a trader, and calendars are one way you could do that. I believe in your example, you guys outlined buying a longer term. I think the underlying you were talking about is AMD, but you can apply this to just about any underlying you're talking about that has an earnings event coming out. An event where you think the longer term vol, it could be a 1 month out and maybe you're selling the weekly, or you may be buying 2 months out and selling the 1 month, wherever the earnings event is happening, wherever you're comfortable trading it, wherever you think that little bit of vol is a little bit overpriced. And then you can buy that longer term vol, which you think maybe comparatively is not as overpriced. And you're hoping that spread is going to widen. That's exactly what you want to happen over the course of that. So you're buying the longer term vol that doesn't have the earnings event baked in, at least not as much as the one event nearer term that has pretty much all earnings fluff. And you're selling that, and you're hoping that when the earnings event happens, in an ideal scenario, the underlying doesn't move. It sits at that strike and sits there, and you see that earnings month just decay, or the earnings week just decay aggressively all the way down to zero. And then you have, as you might imagine, your long one leg that isn't decaying anywhere near as rapidly as a short leg, and the short leg is pretty much going straight to zero in a heartbeat. Then you know that spread is widening out, and guess what? You're long that spread. You're a happy camper. Dan, is that the basic scenario you guys were outlining over there in your newsletter?
Yeah, that's the basic idea. As far as trading earnings, let me tell you a story about trading earnings. So, Mark, you traded index options on the floor, right?
I did. I slung SPX for quite a while.
Yeah, so I guess you probably didn't have to deal with earnings in the same capacity as somebody who was in one of the equity.
Well, I did get into Intel later on in my career. So I did sling some earnings, some individual equities as well.
Oh, okay. I didn't know that actually. That's funny. Well, okay, so I mean, I bet you had the exact same situation that I did. I bet you had a risk manager who told you, "Hey, earnings is tomorrow. You should be flat delta, gamma, theta, and vega, and not have a position going into earnings."
Yeah, they tended to like the flat, flat as you could be reasonably. You're always gonna have something on, but yeah, they like to go in flat and then see what happens.
Yeah. So, like, most professional traders, not all, but most, don't trade earnings. And so, I think that's a good rule of thumb, because most common option strategies are just not really good for earnings. Like, you would never do a credit spread or iron condor or a debit spread, or you'd never buy a call because the implied volatility is so high, or a put for that matter. So it's like you're only left with a very few strategies that are actually even practical for trading earnings. And the time spread is one of them, and the time spread is the strongest one because of what you were talking about, Mark, because the front expiration volatility can get really, really bid up, while the longer term options volatility can stay pretty cheap. So basically you're buying low and selling high at the same time, and you're perfectly hedged. And after earnings, what you tend to see is that front expiration volatility get crushed, and so the volatilities converge. So you can potentially make money on theta, 1 day of theta, because it's a 1 day play. There's no delta. As long as there's not too big of a move, you don't get hurt on gamma. And then you can make a bunch of money on vega. And that's the whole big thing with time spreads and earnings. It's really a vega play. That's what you're trying to do, is make money on that volatility crush.
Yep, trying to make money on vega without getting completely run over by the horrible gamma train that could be lurking in the distance. A couple of caveats, obviously, with this strategy. Dan mentioned it there. It's a short-term play. You're not doing this over months or weeks even. It's probably going to be a few days, set up maybe a few days before earnings, or maybe right ahead of it, and then taken off usually right around that, sometimes even that morning after the announcement, because you don't really want to sit around too long. If the vol has already come in pretty aggressively that morning, pigs get fed, hogs get slaughtered. Take your winnings and go. If you sit around waiting for something to happen, waiting to squeeze that extra couple of cents out of that short leg of that trade, that's when things start moving. That's when, as I mentioned before, the gamma train could come back to bite you. Remember, you are short the front month, you're long the farther off month, but there's less gamma there. So if there's a big move, the short gamma is going to come back to bite you, and come back to bite you pretty aggressively. Your delta is going to be moving quite aggressively as the underlying moves around. So the one thing you don't want to happen in this strategy, and probably not a good strategy if you think this underlying is poised for a big directional move post earnings, you don't want to be doing something like this, because you need something that's going to be relatively tranquil, relatively calm, that's going to have the earnings happen and then all of a sudden pretty much stay around that strike where you're short and kind of nice and happily erode all the way down to zero. That's the ideal scenario. A little bit of movement won't kill you, but a lot of movement could. So that's something where you want to be a caveat with this. So it's a kind of a shorter term trade. You also don't want to do it on something. You don't want to do it on a Tesla or a Netflix, which tends to move, unless you really are certain about how this thing's going to perform. You'd probably want to do it on something maybe a little more reliable, not going to poise to go $30, $50, $100 in the wrong direction against you. So these are a couple of caveats. But it's interesting stuff. These are, people get asked a lot, how should we trade options during earnings? It's even a debate whether you should, like Dan mentioned, whether you should even trade options during earnings. Like you mentioned, a lot of the professionals don't come in that time because they consider that to be kind of almost roulette wheel time. You're kind of rolling the dice. And there are a lot of setups, and maybe we'll get to see these on a future show as well. There are some setups you can do to take advantage of that nice little increase in earnings volatility leading up to the event itself, and then taking it off and getting the heck out of Dodge before the event itself, because the event is where the rough waters happen. I kind of equate that usually to going over Niagara Falls in the barrel. Maybe you don't want to get to that point. Maybe you want to get out of the river right before that point and have enjoyed a nice ride along the way. And there are some ways you can do that. Maybe that's a good subject for a future a future episode. What do you think about that, Dan? Maybe we'll talk about calendars during earnings now. Maybe for a future show, we'll talk about some things you can do, because there are a lot of people out there who maybe they don't want to be there going over that proverbial cliff or waterfall earnings, but they want to trade maybe up to that point. That sound like a good idea for a future show?
Yeah, that sounds like a great idea. Well, I have stuck in my head now Niagara Falls, and I'm thinking of like the old Elvis and Costello bit. You ever see that one?
I never saw that one, no.
Niagara Falls, slowly I turn.
No, I don't know. I know the old Who's on First. I know like Abbott and Costello Meet the Wolfman, some of my favorites, but I don't know the Niagara. I'll check out the Niagara Falls one. Now I'm curious. Here we go. Nice current contemporary comedic references here on the program for you, Dan. But yeah, I think that's a good idea. Maybe that's a good nugget for a future newsletter as well. You played one side, not playing the other. But yeah, any other final thoughts here? Again, this is kind of just a quick overview of a use case you can use for calendars. Again, calendars, I know they're a little scary. They're a little bit maybe beyond a lot of basic retail guys, but that's why we're here. We're here to kind of ease you into these things. If you want, full in-depth discussion of them, again, check out our archives, go to our website, type that in, go to a bunch of other great sites like, the Options EDU folks over at OIC, all free. And then, of course, if you want someone to hold your hand and help you execute these things, contact Dan and his team over there at MTM, and they will be happy to do just that. Any last thoughts there, Dan, on calendars, maybe some pros and cons, or their use case specifically during earnings? And then also, if you guys over there at MTM, outside of your free newsletter, I'm sure you guys must have something like a calendars class, something like that. So if someone here is intrigued by what they're hearing about calendars, where should they go? What should they do?
Yeah, actually, I'll tell you what, we do have a calendar class. It's actually in the bin. It's recorded, ready to go. It's 4 hour and 15-minute sessions. That's just one component of our online education series, which is what we do with the online education series is every month we do a 4-part series. And they're all on a different topic. And this month is actually on verticals, but 2 months ago, I think it was, we did one on calendars. And if you want to take that class as well as the vertical class, and there's a volatility class in there, there's a bunch of really great classes, about 30 hours of content. Go to markettaker.com/options, plural, _education. markettaker.com/options education.
Any last thoughts on calendars here and using them during earnings before we move on to some of their questions, Dan?
Oh, yeah. No, I mean, just let me hit pretty hard on the idea that these are pure volatility plays. And by the way, I set up, when I teach earnings calendars, I tell people you should put them on the session before earnings comes out. So if it's coming out in the afternoon, put it on that day. It's coming out in the morning, put it on the day before. So just a couple hours of trading left before earnings comes out from when you put it on. And then you're taking it off the next day, hopefully by lunchtime. You kind of have to wait for the volatility of the short option to come in a little bit. So it should be, if you're doing it right, it should be pretty much less than a 24-hour trade usually.
There you go, listeners. Check it out. Check out the archives. Check out Dan's classes if you want to learn more specifically about calendars. There's a lot of stuff out there for you to find. Speaking of you guys, though, and some of your questions, some of your thoughts, got a little bit of time here in this episode, so Dan and I thought we'd answer some of your questions. We'd open up our mail call segment.
Mail call. Time to look at questions submitted by our listeners.
I love it, Dan. Whenever I hear that, I always feel so patriotic. It feels like July 4th whenever we do this show. I don't care if it's January or December or whenever we do it. It just feels like, doesn't it feel like you should be waving a flag and a sparkler when you hear that?
How do you know I'm not?
That's true. I don't have you on video, thank God, because knowing you probably are on any given day over there in Frankfurt. Who knows? Throwing fortune to the wind and doing whatever down there. All kinds of fun stuff going on. And scenic and sunny, certainly sunny these days, Frankfurt, Illinois. Well, mail call, of course, like the man said, this is the portion where you guys get to take the reins, the inmates taking over Arkham Asylum here and hitting us up with some questions, some comments. Easiest place to do that. You guys like the Twitters at Options over there on Twitter. You can also hit up Dan. He'll forward us some questions. We'll maybe answer them directly. He's just Dan _ Passarelli. That's 2 S's, 1 R, and then 2 L's. It's a hard one to figure it out over there. You can hit him up with questions, and maybe he'll forward them to us, save them for the show. Maybe he'll just be nice and answer them himself. A lot of ways to hit us up. Of course, add options on Stock Twits as well, or Options Insider over there on Facebook, or hit the website feedback form, or in the live chat. You guys can hit us up there as well if you are one of the lucky few who can hit us up when we go live, these little surprise live streams for Bootcamp. I always like doing those as well. So we ask you guys ask us questions, I should say. Sometimes we ask you guys questions a little bit as well. Let's kick it off with some questions. We asked these guys last week, Dan. We said, hey, VIX is kind of giving up the ghost these days. So where are you looking? Which products are you looking at to hopefully maybe provide a few new sources of volatility for your options trading? I'm going to go on a limb and say you didn't check the notes, so you didn't cheat. We gave them the choice, Dan. Crude oil, metals, FX, or let's say an individual equity like a Tesla or something. What do you think? What would your guess be, and what do you think won our poll?
I would guess. I mean, we at Market Taker we look at all those things, so I wouldn't really pick one for myself, but I would guess that people said FX.
Interesting. We did tweet that right in the heels of the whole Britain vote, and so FX was on the minds of a lot of people. I kind of thought individual names like Tesla would win it, and it was winning for a while, but crude surged towards the end. 33% choosing crude, which I thought was kind of interesting, and then 27% for the individual names like your Teslas and Facebooks and Googles and whatnot. And then a tie, 20% for metals and FX. Fast forward to this morning, Dan, we asked people our question of the week this week. And we said, hey, going back to the VIX, because it keeps hitting new lows. We asked you guys about a month or two ago, hey, how low will the VIX get in 2017? About 40% of you picked 9 as the floor, but starting to threaten that level. Hit 937 last week. Rallying hard today, up about nearly 12 again, so maybe that's in the rearview mirror. But that said, what do you think? What do you think will be the low this year? We have to ask again because we did get perilously close to that. So are you thinking that we still won't break 9, or we won't get down maybe below 8.5, or maybe we won't get below 8, or maybe you're just like, look out below, we're going to have a 7 handle sometime this year? Mr. Dan, this year hasn't really played out as anyone expected from a vol perspective. Everyone thought Trump equaled volatility. So far, it's been pretty much exactly the opposite. What is your guess, and then what do you think is winning the poll, sir?
Well, yeah, I mean, I'm sure I'm not looking for a 7 or 8 handle or anything like that. I think volatility is going to pick up. There's going to have to be a catalyst. Well, I mean, there's going to have to be a catalyst. And we basically get a catalyst every day, and it doesn't do anything. So I don't know what that catalyst will be. I mean, what it will be is it's going to be one of the big houses saying, okay, today's the day that we are all stocked up with crazy, and we're going to sell out of our lungs. And then, that sets off the wheels in motion. But anyway, I'm looking for volatility to increase, get into the double digits, but we'll see. And I think I bet our poll says that too.
It's funny. Today might be that day, Dan. The market isn't selling off too aggressively, but VIX is in rally ho mode, up almost over a point and a half, back threatening the 12 handle again in VIX cash, which is almost 3 handles north of where it was just a session or two ago. So these things, how they swing and how they change. By the time we wrote that question this morning, the volatility regime already changing yet again. But let's see how our listeners have been voting so far, and they're still in that same camp. They're about 69% actually saying it won't break 9. I think some of that may be influenced by today's activity. A lot of people are very, very, very light in the short-term memory department sometimes. 8% saying it won't break 8, and still number 2, Dan, with 23% saying look out below, a 7 handle's coming in 2017, which is interesting. We talked about this on our Volatility View show, Dan. There was some interesting research coming out of Barclays recently. And again, you look at the different houses, they have research to suit their own purposes. Goldman says VIX should be higher. And then Barclays comes out and says, well, actually, if you look at the math and how the VIX is actually calculated, a lot of it, the juice right now is coming from the convexity, the bid of these far out of the money puts in the S&P. If that bid comes in a little bit for these puts, then we could actually see VIX a handle or a handle and a half lower. So they said actually, by the actual calculation, a 7 handle is not as outlandish as it actually might seem. And actually, if the VIX had been calculated all the way back to the 1960s, they extrapolated a little bit. About 10% of the time, it would have been below 10. So below 10 wouldn't be as perhaps, bizarre as it is right now, but we have a limited sample set. So that's kind of what we're looking at. But interesting stuff out there. You guys have all week to vote if you haven't done so already. Let's get to your Qs here and RAs. Dan, here's a fun one. This comes from, perfect for a show like this. This comes from, this is a great handle, Lesnod. He or perhaps she asking, hey, how the heck do you get out of straddles? One side of a straddle is always a loser, correct? I like this question, Dan, because it is something we don't talk about, but it is something people encounter when they're trading straddles for the first time, because that's kind of how they play out. One side is generally going to be the winner. So, Mr. P, how do you guys deal with that over there in the land of MTM? What do you teach your mentees when they're slinging some straddles?
Well, you never think of spreads as, well, one leg won and one leg lost, so, this is a terrible trade because one of the legs lost. Like, you look at it as a single package. Like, you would never look at vertical, like a credit spread, and say, oh, well, I made money on my short option, but I lost money on my long option. I'm doing it wrong. Like, you wouldn't do that, And so you shouldn't with straddles either. Straddles are all about gamma, when the market moves in one or the other direction, the underlying moves in one or the other direction. What you make you make more on the option that's winning and lose less on the option you're losing because of gamma. And so that's sort of the big thing. So don't really think about it as making on one, losing on the other. Think about it as I'm making money on gamma. And so how do you get out of them? We've taught some classes on this as well. There's really two different ways. Way one is, if it moves and you're up money on it and you hit your profit target, always have a profit target to start with. Just close the darn thing out, close both legs, call and the put, go back to zero contracts, take the money and go blow it on something frivolous. Or way two is you can kind of quasi-gamma scalp and sort of leg out. I don't recommend getting crazy with this, but, for maybe your first partial exit and maybe even your second partial exit, it can make sense. So maybe I bought 10 calls and 10 puts, same strike, obviously. And the underlying goes up a lot. Well, I made money and my calls are now in the money and their deltas are big. So I'm making money on call deltas. What I could do is I could sell some of those calls, a portion of them, to get back to being zero delta. So now it's kind of interesting. Now I have a ratioed straddle, but I'm back to zero delta. And now it doesn't matter if it goes up or down, I can still make money. And in fact, if it goes back down, I can just buy those calls back at a lower price.
Yeah, I like that. It's kind of a poor man's gamma scalping. That's something we talked about before on the show. One of the reasons why I'm hesitant to counsel any retail guy to really get into, particularly the long side of the straddle positions. People think, straddles, what can go wrong? I saw people getting hawked those for a long time in late night infomercials. Make money no matter where the market moves using options. Guess what they're hawking you? They're hawking you long straddles. But, the reason we don't advocate that very often on this program is it's a challenging way to make money. You think, I'm buying this thing, and no matter what happens, I win. But chances are that thing doesn't happen, and so you lose. Or it doesn't happen in enough time, and you lose. Because remember, the clock's ticking with options, and if you buy two on the same strike, you have effectively double the decay that you're paying now. So every day that doesn't happen, or it doesn't happen fast enough, or in the degree of the movement you need, then that straddle's going away. And if it takes a few days longer than you hoped for that move to play out, you could still lose on that trade because everything else has decayed more than you planned for. So that's why long straddles are always so challenging. That's why I like your idea, Dan, because the one thing we've always said, and when we were professionals on the floor, the one way we would always defend a long straddle type position was to gamma scalp it, sell the underlying above it, buy it back at the money or below it, and do that over and over again throughout the day. And that's how you made money, or at least prevented losing a lot of money on a long premium, long straddle type position like that. But that's a hard thing for our retail to do because it ties up a lot of capital. You don't have the same margin efficiencies to sling a lot of stock back and forth. So the way Dan laid it out is actually pretty good of using that kind of poor man's gamma scalping. Do it on I like the ratio delta neutral version, Dan, as opposed to what people normally do is like in your scenario, you said, you're long 10 of these things. When it goes their way, they just dump the 10. Like, okay, now I got a free, put leg or the other leg, whatever it may be, A lot of people do it that way. I like your kind of, let's call it ratio poor man's gamma scalping a little better than just closing out one leg at a time, even though that could work too. You can do it that way, but I like your way. So you get a point there.
Mm-hmm. Yep.
Those bootcamp points, you can trade them in for, at your local retailer for all sorts of fun prizes. So stay tuned for that. Meanwhile, we got more questions here. What do we got? Oh, I like these. These are kind of two similar questions. I like this handle. This first guy goes by Meats with a Z. And he says, would you describe successful options trading as primarily singles and doubles or more swing for the fences, home runs? Then we have a similar question here from Bullseyes, also with Z's, a lot of Z's today. Are options worth it for day traders or just swing traders? So two kind of similar cues here of both kind of asking, how you should set things up and do a proper approach to them. I got a feeling I know how you're going to answer these, Dan, but I'll let you run. Maybe we'll start with the first one there, but the second one is kind of related. Are you counseling your mentees over there at MTM to just load up and swing for the fences every day, or are you getting more into the singles, doubles, and triples run?
Yeah, definitely looking more for the singles and doubles. That's where you generate consistency. I mean, to be fair, there are some traders who try and make a living out of, swinging for the fences. But it's a pretty demoralizing, tough way to make a living if you can make it work, which you probably can't, because when you're swinging for the fences, it's kind of like, it's Babe Ruth style. Babe Ruth at one point had the most strikeouts in baseball as well as the most home runs, so you're gonna get struck out. You're gonna lose, win a little, lose, win some, lose, and make it big and make back all those little losers you had. And that's a psychologically difficult way to trade for a lot of people, and it's just really tough. I don't really know many, if any, traders who could make a living doing that. What was our second question?
Second question was, are options worth it for day traders or just for swing traders?
Yeah, so they're generally speaking not worth it for day traders. Now, there's a very small minority of people out there who have come to me and said, hey, all I do is I day trade options. Can you help make it better? And, I'd say, well, how's your success rate been? They say, oh, terrible. It's like, well, that's because it's really hard to do. And the reason why it's hard to do is because day trading requires delta moves. Like, you're not making money off theta as a day trader. You're probably not making money off vega as a day trader. It's all delta moves. So what you're doing is you're buying higher delta calls or puts. You're not doing like iron condors for one day, And so, first of all, you got to be right, which, is here nor there. I mean, that has the obvious challenges. But what really makes it hard is that as a percentage of the value of the option you're trading, the bid-ask spread for in-the-money options with high deltas, or any option for that matter, can potentially make up a pretty big portion of the value of that trade. Like, it's not uncommon to see an option $1 bid at $1.05. And that's a reasonably tight market. I mean, that's 5%. When you're getting in and out of trades, you're giving up 5% because you're typically buying the offer and selling the bid. Even if you try and middle the market a little bit, you're still going to be giving up something. So the bid-ask spread makes it almost impossible to day trade options and make it worth it. Because, I mean, think about it. Like, if you're day trading shares, the bid-ask spread is going to be more narrow, especially as a percentage of the asset. And those are 100 deltas. The stock runs $1, you make $1. If you're long as 65 delta call, stock runs $1, you only make 65 cents. And you're giving away in slippage in the bid-ask spread a good proportion of that, plus commissions. So Yeah. Do yourself a favor, guys. Avoid day trading options. It's just a tough way to try to make money. And that one, I don't know if I've ever heard anybody give me a long-term success story like, oh yeah, I've been day trading options for 5 years and I have consistent profits. I don't think I've ever heard anybody once tell me that in 24 years in the options business.
Yeah, I'm kind of with you on that. Options they're a challenge for that. They're not well suited to that particular use case. That's, like you said, better suited to the Delta One quote type trading of stocks or futures, which you can scalp minute tick by tick trades in the underlying if you want, because that's exactly what those underlyings are set up for. They're delta of one because they are the underlyings. So every tick they move with it because they're the underlyings. You can scalp that stuff a lot easier. If you're trying to capture those types of movements using the options, you're always going to have a delta less than one. So it's not going to be as efficient unless you're doing some really, deep in the money type thing, which at that point you might as well trade the underlying anyway because you're spending almost as much. And also, it's like we talked about a lot on the show. We talked about Vega before. We talked about Theta. Those things take time to play out. Time decay takes time to play out. You can't have it happen. I mean, you can't have it happen in a day. We just outlined an example where you can, where around these aberrant events like earnings, where these dramatic things can happen intraday. So there are opportunities to trade intraday. Don't get us wrong. But day in, day out, slinging intraday, it's a challenge. And that's why we say, usually most of the strategies we talk about are, playing out over days, if not a week or more, just because that's kind of how long it takes for these things to play out. I will say, though, if you are leaning more towards the aggressive type trading, this is one of the better environments product-wise that you've ever been in, just because there are more products for you to choose from. It used to be, if you wanted to trade intraday, you had to use a monthly option. That's the only choice you have. Now you have a preponderance of weeklies and just about every product you can even think of. So that does help you a little bit. Those are more high gamma type products. So if you want to capture a little bit of bang for your buck, a weekly is going to help you do that. So there are more products out there for you to choose from, but it still is a rough road to hoe. And outside of these, aberrant, very rarely do we see dramatic volatility swings in an underlying intraday. It does happen, does play out. Usually it's around some sort of big event. Planned or unplanned. If you're just doing it day in, day out, looking for skew to change dramatically or looking for aggressive time decay or anything like that, that's a rough road to hoe unless you're jumping from one underlying to the next. That could be, you could do it. It's just a bit of a challenge. And so as long as you're prepared for that and you're okay with that, then let's go on. Speaking of intraday, let's go this question here from Axel D. He wants to know, why does open interest only update once a day? This is the perennial question. We get this a lot, usually around earnings time, but usually we get it, pretty much throughout the year. It's a common question. Trades used to go up when Dan and I walked on the floor. You would get you put up your trades on paper cards, and they would a runner would take those cards and bring them out to the desk. They get stamped and processed and go up to the clearinghouse. And sometimes, if you were lucky, they'd come back to you. If they did a trade early enough in the day, they would come back to you a couple hours later on the middle of the session and say, hey, we have what's called an out trade. You're reporting 10 contracts. Dan's only reporting 6 because Dan's always full of problems. We know that. So you have to reconcile that. Sometimes they would catch it that day. Usually, it would actually be the next morning. You have to have come in, your clipper come in early. You have to get your out trade list where your trade didn't match up what the other guy said. And you go down to the floor and you negotiate it out and you haggle it out. And that was the way it was done. And that's why we have this 24-hour kind of period of open interest updating. And now the technology has increased dramatically. Trades are going up in milliseconds and microseconds. And yet we still have this seemingly antiquated system of the open interest only updating once a day. And it's a little bit confusing for people. I understand why it is. I think the people you have to really ask this question to, and I have put it to them in the past, is the people over at the OCC, the Options Clearing Corporation. They're the ones who would have to actually undertake the upgrade to their systems to do that. And they could, technologically speaking, it can be done now. There are still some problems where, is this really opening right now or closing, and how does this equate to other customers? So getting that stuff down, it may be a little bit of a challenge to go instantaneous, but maybe you definitely could do like a midday and then an end of day, just to increase it a little bit. But they don't seem really that inclined to really want to undertake that massive overhaul of their system right now with all the expense and everything else that would be inquired. And also, quite frankly, the retail wants more transparency, but there is a cadre out there in the institutional side that don't want that. They don't even like updating every day. They don't want people being able to look at the open interest and kind of intuit what they have on and what they've been putting on. So there is a certain segment of the marketplace that isn't in favor of this kind of increased, transparency, and they wouldn't want that. And they have some big sway at some of the big firms and exchanges and places like OCC. So there are mutual interests coming together here. So if you have big people pushing against it, and on top of that, it's a onerous and expensive and difficult undertaking to do. And you still probably can only get to like probably around a couple updates a day, maybe hourly if you're really good about it. Then I don't think it's going to be happening anytime soon, even though the technology really is there to probably get the ball rolling now. So I understand, I feel your pain, but yeah, I don't see it unfortunately happening anytime soon. What about you, Dan? You must get this question a lot from your mentees.
I don't know. I don't recall being asked that, at least for a while. And I guess, Mark, you said it exactly right. I mean, that's what I would figure too, is that, it kind of comes from the days where it was just not possible to update it until the end of the day. And I don't know. I mean, maybe now we're getting close to having the technology to do it more frequently, but yeah, I don't imagine that being a priority. You talk to the OCC, you talk to brokerage firms and exchanges, and any innovations, anything they're spending money on, any changes in technology seem to all be about new products, how to get people to trade more, as opposed to, giving you more information. Like, that's a cost to the options industry, not a revenue stream.
Yeah, unfortunately, you're right. There are, like I said, there are competing agendas, and sometimes, especially in this day and age when liquidity has issues and fragmentation outside of the top 22 names, as we learned at the Options Industry Conference, outside of those, there are some liquidity issues and everything else. There are other priorities in the industry rather than tackling this, which will be a big fight. Don't get me wrong. Tackling that one probably is not high on their priority list. All right, we're talking about expirations and options. Let's get to this one from Mary. She wants to know, what's the shortest expiry available for plain vanilla options? So plain old vanilla regular listed options, let's say equity and index options. Let's just keep it pretty simple before we get into some other crazy stuff. For that right now, like I mentioned earlier, you're in an environment where there are more expiration choices than ever before. It used to be monthly, and that was kind of about it, and you can go out as far as you wanted in the monthly space out to years. But there wasn't much on the shorter duration, and in the last 5 or so years, we've seen this renaissance of weeklies. Most major products have a weekly in them now. So if you want that, that's pretty much your go-to choice for the shortest duration, go-to standard plain vanilla listed option. We get questions every now and then. It's kind of a corollary to this question. Will we see dailies anytime soon? I put this to some of the exchange heads and some others a few times. They don't seem that inclined to want to go that way for a variety of reasons. The hassle, fragmenting liquidity even more, putting more strain on the market makers with more products. And also, there still are some people in the business who don't like the connotation of options and some sort of speculative gambling type instrument. And the shorter duration you get, the more it gets closer to that type of use case. So they tend to pause at that. But that said, we do have weeklies now. And if you're looking at the weeklies, the weekly calendar is lining up. So in some big products like SPX and others, you have a Monday weekly and a Wednesday weekly. You have your regular expiring Friday weekly. So you're getting to that point. All you're missing really is a Tuesday and a Thursday. And then you pretty much have a weekly that expires every day of the week. And once you have that, you effectively have dailies because you'll have something popping off pretty much and expiring every day of the week. So if you want weeklies, particularly in some of the bigger, more liquid top names, then you just wait a little bit. Wait another, I'd say 6 months to a year, and you'll probably see weeklies expiring every day of the week. And I would think that's probably as far as we get until maybe down the road we'll see someone, probably a smaller exchange, say, hey, I want to do dailies. But for now, I think your daily weeklies, for lack of a better term, are probably your best bet in there. Any thoughts on this, Mr. P?
Yeah, I mean, Mark, you're answering that question from the context, and this is probably how it was asked too, but you're answering it in the context of like when an option is first listed, how much time is there until expiration? What's the shortest time period? But you have, the audience needs to keep in mind that if there was an option listed 600 days ago because it's a Leafs option and 599 days passed, well, that option has 1 day until expiration. And at the end of the day, at 2:59, it has 1 minute until expiration. So you still have all these different choices. Like, there are one-day options when it's the day before expiration. There are 2-day, even options that have just monthlies listed on them will have one-day options once a month, So I don't know. I mean, for me, I like to tell my students, don't get too hung up on all that business. And to me, I think just adding more and more expirations gets to the point of absurdity. I mean, we learned at the Options Industry Conference that I think it's 40% of all options are weeklies. Do you remember hearing that statistic, Mark? Or?
Yeah, particularly in some of the big names, S&P is probably more, but yeah, net it is somewhere in that realm. So people are loving themselves some weeklies these days.
Yeah, so I mean, people like them. People like the short-term options, for a lot of reasons. But don't get too hung up on when the expirations are. I mean, look, when you want to trade, what you do is you log into your account, you pull up the option chain, and you say, well, here's what's available: this expiration, this expiration, this expiration. And pick the one that's most suited to your needs. If there's not weeklies listed, you know why? Probably because there's not enough liquidity, and it would just be a crappy trade with a wide bid-ask spread, so you don't want them anyway. So just trade what's there, and don't worry about it.
There you go. Don't worry about it from Mr. P. I like that. That's the hippie Frankfurt answer out there. All right, what do we got here? We got time for a couple more. Let's go to Lincoln, however he pronounces his name. He says, my go-to options strat is to sell covered puts on stocks that I want to buy and then get paid to wait. If the stock comes my way, I eventually trade out of it using a covered call. What do you think? Is that savvy or is that stupid? Covered puts, obviously, listeners, are puts that you sell where you have the money in your account. You keep the money in your account to buy the stock in case the put, the underlying doesn't go your way and you get assigned the stock. You have the money to buy it. It's an analogy in some ways to the covered call. You guys all understand what that position is. You don't hear covered put that often, so I like to clarify it whenever we get out there. But I like the strategy. I have no problem with this. I've said many times that I think these are the use cases that even the most basic stock guy should be doing when it comes to options. If you're a basic stock guy, then you know how to buy a stock and sell it. You know how to work limit orders. That's pretty much what you do in the stock world. So if you can wrap your head around that, you can wrap your head around selling a covered call instead of working a limit sell order, and you can wrap your head around selling a covered put instead of working a limit buy order. If you just take those two small little steps, and maybe the put's a step too far. Maybe you start with the call because everyone can kind of wrap their head around being long a stock and then selling it. It's maybe a little bit bigger leap to not being long anything and then selling a put and then all of a sudden you're being long the stock. I get that. So maybe you want to start with the covered call, and then as you understand that, you start with the put. But I'm totally okay. I think this is a good use case for options. You sell the put as long as you've identified a strike where you're comfortable buying the underlying and you understand all the risks inherent in that. You understand if there is a gap. That's probably the one thing where you're going to be worried about there the most with that short put type strategy. But as long as you're cognizant of that and you're comfortable acquiring the underlying at that level, at that strike, then I think this is a perfect use case for options. Senior P, what do you say to this, sir? Point, counterpoint.
Did it say covered put or cash secured put? Because those are two different things.
Well, I think what he meant, I'm reading between the lines. He meant cash secured put. That's what I meant.
I see.
Yeah, I don't think. Yeah, I see what you're saying. I was perhaps liberally interpreting that for our audience, but that's how I interpreted it.
Okay, I gotcha. Yeah, I mean, I do like that strategy selectively. I mean, that's definitely not one where on every single stock there ever was, you can always do that every single time. But I think it is pretty practical. I think it's really, really useful. It is a strategy that we teach our students, especially the more investing oriented as opposed to like real active trader oriented. So yeah, I like it. Sure.
Restrain your enthusiasm, sir. All right, we got time for one more here. Let's go. What do you want? I'll let you choose, Mr. P. Do you want a VIX so low VIX kind of what do I do? Can I sell options question, or do you want a earnings kind of straddle? How does it work question? I'll let you pick.
Let's do the VIX one.
All right, it's kind of appropriate given where we are right now. This one comes from the creatively named Steve. He says, with the VIX so low, I'm not selling a lot of, so many double negatives. I'm going to read between the lines again here. With the VIX so low, I'm not selling a lot of options anymore because I'm afraid that I won't collect enough premium. Am I thinking of this incorrectly? So many negatives. No, you're not thinking of this inherently incorrectly, Steve. VIX is low. VIX is, of course, the at-the-money implied volatility of the S&P 500. There are a few little tweaks in it that make it not just the at-the-money. There is some skew baked in there, some puts and some calls and things like that. We won't get into that now. Check out our archived episodes about volatility in the VIX of this show, or go check out pretty much any episode of Volatility Views. We get into that in very, very great detail if you want more of that. But in general, that's showing you that right now the at-the-money implied volatility of the S&P 500 is low, aka the volatility of most of those big names in the S&P 500 is also low. So if you're writing a lot of options in those names, chances are you're getting lower premium than you normally would. So that's pretty much what that means. Now, if you're selling names outside of it, like we said at the top of the show, there are other places you can go. You can go to commodities. Maybe you want to go to crude, or you want to go to the metals, or FX, or maybe you want to pick some rocking and rolling individual names like your Teslas, or your Facebooks, or your Netflix, or whatever the case may be. There is volatility to be found out there. You have to just go look for it, and it's a little bit more dangerous as a result because it could be underlyings you're perhaps not as familiar with, and they tend to move. But in general, yes, you're not going to collect I don't know about enough, that's a subjective term, but you won't collect as much premium as you would if the VIX was much higher, say in the 20s or 30s. So in general, you are thinking of this correctly, not thinking of this incorrectly. Mr. P, anything you want to add here for our friend Steve, who's full of negatives about the VIX?
Yeah, that's right. I mean, there are some times when the market is more conducive to option trading in general, and sometimes when it's less conducive. And low volatility environments, low VIX, it's usually tougher to find trades, buying or selling trades, which at first seems a little counterintuitive because you would think, well, if options are cheap, I should want to buy them. But, they're cheap because the historical volatility has been low, and so you're not going to make anything if you buy them. So, yeah, it's really tough. I mean, this kind of brings us to, like, the most important thing to understand about options is that options are volatility products. You're always going to either make money or lose money on implied or historical volatility. Like, that's it. I mean, it could be directional biased historical volatility if you're making a delta trade like buying a call, but you're always either going to make or lose money by the underlying moving historical volatility or implied volatility moving. So when implied volatility is low, right, you're exactly right. It's unattractive to sell options because you're not getting much premium, but you still have the same potential risk. Like, even if the market's not moving, which sounds great, anything can still happen. So that's what they call picking up pennies in front of a steamroller, if you ever heard that phrase, options idiom. But then you don't want to buy options either because if the underlying's not moving, you're just going to die a slow death of time decay. So keep looking. There are always still trades out there, even when the market's not super conducive because vol is low. There's volatility somewhere. You just got to go find it.
There you go. Good words to end it on, sir. Unfortunately, that's all the time we have for this episode of Options Bootcamp. But before we go, let me check back in with my cohort. He mentioned at the top of the show where you could go to get his free newsletter. He also mentioned how you can go learn about things like calendars during earnings. That said, Mr. Dan, what else are you guys cooking up over there at MTM that may interest our listeners?
Well, we do have a lot of stuff going on. As a matter of fact, we have a trial of our group coaching class for $49 for a full month. And you can get that by going to markettaker.com/49, cleverly enough, markettaker.com/49. Try our group coaching trade idea class where you get about 10 different options trade ideas every single day with the education to be able to manage them yourself. So check that out if you're looking for trade ideas, high quality trade ideas.
There you go. Idea generation, always a big thing. So on behalf of Dan and myself, I want to thank all of you out there in the listening audience for downloading, streaming, subscribing to the show. Of course, sending in such great questions. Keep them coming. They really are the lifeblood of the show. They inspire us, topics to talk about and fun stuff, and they want us to know what you guys have on your mind, what you want to know. That's very helpful for us. And of course, if you're listening live, come back in an hour for our big option block program. It is Monday after all. We'll see you then. And Dan and I will see you next time here for more of Options Bootcamp.
Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.